Hello, everybody, and thank you for watching our interview with Darren Tyson Chan. My name's Michael Houghton. I'm the chair of the Lucerne Alternative Investments Fund Investment Committee, and with me is Anthony Murphy, who's a member of the Investment Committee for LAIF. We've taken the opportunity to put together another video to expand on some of the topics that we discussed with Darren, and I'm just going to introduce in a bit more detail some of the things that I mentioned. In particular, LAIF is a retail fund or a registered managed investment scheme, as many of you would know it. It has the ability to accept investments from as little as $25,000. Now, what's unique about that is, of course, how else does a self-managed super fund get to invest in alternative investments if it doesn't meet the sophisticated investor test? This is the way you get to do it. I mentioned in the interview with Darren that in particular, alternatives are an asset class that are getting a lot of traction, a lot of interest. Many people are wanting to invest in it, either don't know how or can't access it. One of the things that LAIF does provide you is the opportunity to access alternatives. Alternatives, as defined by the investment market, are typically anything that are not equities, bonds, cash, and for our purposes, property. So what does LAIF hold, or what sort of alternative investment classes does it participate in? It varies. We're very fortunate, given it's a fund of funds, that we can go across a spectrum of assets within the alternatives universe. This can include precious metals or gold, cryptocurrency and blockchain and DeFi, to hedge funds, CTAs or commodity trading advisors, which are systematic trend funds, to to volatility funds, etc. So there's quite a few different things that we can invest in. And in addition to that, you've got your more commonly known, such as private debt and private equity as well. I mentioned earlier that the minimum investment is $25,000. The other really unique feature of LAIF that self-managed super funds in particular benefit from is monthly liquidity. That means that you not only have to have the ability to invest your capital for the longer term, but should you need to withdraw some money or for whatever purpose, all of your money, it's available monthly. So what has LAIF actually been able to achieve over the last couple of years in what have been fairly strong times for various asset classes, but it's been able to outperform equities markets in particular, so your more traditional asset class, in both 2020 and in 2021. And Anthony's going to talk a bit more about why and how we were able to do that. But this line chart here shows you in particular where in March 20, where the COVID crash took place, and equity markets were down 30, and some other markets were down even more than 30%. LAIF was only down 5% in the month of March, and since then has been able to participate in the various rallies in various asset classes that have taken place. So when some asset classes underperform, others outperform, we've been able to capture that performance. And that's one of the strengths of the fund. One of the other things I just want to quickly touch on that I did mention when talking with Darren is that alternatives are not only an asset class that are being spoken about by many investors and typically only available to professional investors. It's also where you'll find some of the big super funds are investing their money, and also the future fund. What you'll probably find interesting is the future fund, for example, has about 45% of its portfolio allocated to alternative investments. And that is a fairly hefty weight for a fund like that. But then when you look at its performance, it's been performing an average of 10% per annum since inception, which is about that is about 4% more than they're targeting to perform. And that is largely attributable to their allocation to alternatives. And the same could be said for a lot of industry super funds and how they allocate their assets. I think the next stage that you'll see on the bottom of this slide here is how the fund is allocated, the strategies that I mentioned earlier, the weightings that we've got to them. And that is because the investment committee does take the time to think about the themes, the types of investments that will make sense for those themes, and how we want to size our allocation to those investments within a theme. And I'll probably hand over to Anthony now to talk about a couple of those investments that we've made and the themes that we've identified and what we're doing to continue the strong performance of the fund.
Yeah, thanks, Michael. And just for the audience benefit of the pie chart that you can see on your screen at the moment, highlighting those different strategies, obviously within some of those strategies, for example, the long short equities, we have a number of different funds at play. So currently right now, LAIF is running at 15 to 16 different underlying investment funds and or strategies within the portfolio. And at any period in time, we'd see that number oscillate somewhere between circa 12 to 18. So from that perspective, we want to have conviction in the ideas that we're taking. We've seen historically that the performance of many fund of funds out there has been quite underwhelming simply because they have too much diversification in there. And the real purpose of LAIF is to be a diversifier, but also complementary to other return profiles in the portfolio. I think when we talk about where we've delivered performance from, it's what's more important is the performance that we've been able to attribute over the last 2 years in particular is historical. So how do we continue to derive returns and make money for investors when we feel that the economic climate is going to be far less favourable for investors going forward? And we think that's going to be the case for quite a period of time. So if we think about capital preservation, that's probably really front of mind for us when we think about LAIF. And if you have a look here from when the fund started on December 1st, 2017 to where we are today, this highlights a negative months that the ASX 200 has experienced over that period of time versus the performance of LAIF. And probably the two parts that I'd highlight the most that Michael touched on before, in particular, was March 2020, when the fund had a drawdown just over 5%, and the market during that period of time fell as much as 30% at one stage, but closed the month being down 25%. So being able to preserve capital when markets are extremely volatile and dislocating to the downside allows us to compound off a much higher capital base. And so we're able to preserve capital effectively during the COVID crash and do that well, and then grow off that much higher capital base than what equity markets were coming from. We then found our next stress test was in January this year. It felt like the market woke up at the start of 2022 on the back of a lot of hubris behaviour over the last couple of years. And there was that correction that everybody was expecting. So we're proud of the performance that LAIF delivered in January. Again, it was up 0.8, whilst the market was down 6.35%. At the time of this recording, it looks like LAIF's going to deliver a positive quarter for March of circa 2.4 to 2.5%, again ahead of the market, and that's primarily driven by that capital preservation period in January and that significant outperformance. And some strong returns again for the month of March. Where we're moving, where we believe as an investment committee, is into a very difficult economic environment where we've got inflation that's really rampant at the moment. We don't think that's going away. We do not think it's transitory. The RBA has now done a backflip on their monetary policy, and they are going to start increasing rates this year. They've been on the front foot about that in recent times. So if we think about traditional asset classes or passive investing has worked incredibly well for investors over the last decade, and we acknowledge that. The rise of ETFs and industry super funds and pension funds as a whole. But that's all in the past, and we know that economic conditions are going to be less favourable. We know that companies are going to pay a lot more to borrow capital. And so as a result of that, how do we invest going forward? One thing that's been really pleasing for us with LAIF is although we've been able to continue to get returns as good, if not better than the market, particularly over the last couple of years, we've been able to do that whilst reducing our correlation to the market. So our reliance on equity market conditions being positive. So you can see here that as the market has continued to rise, we've actually started de-risking our reliance on the market or our correlation with the market. And as Michael said before, that's by actually participating in strategies that have less reliance on equity markets. So in investment circles at the moment, everyone seems to be talking about gold and resources and digital assets. Well, they're themes that we've owned in LAIF since early 2020, not 2022. So again, it's about being in front of the curve, not behind it, and identifying those emerging trends and then figuring out the best risk-adjusted way in which to own them. And that's really the ethos of LAIF. When we look at the annualized volatility as well, so I've just touched on the fact that we've been able to produce those returns by taking less correlation to the market. We'll also be able to reduce those double-digit returns on single-digit volatility, which puts LAIF on a Sharpe ratio of close to 1.4 compared to the market that's trades at about 0.6, 0.65. So what that basically means is for every percent return the LAIF is generating for you, you are taking far less risk than the ASX 200 in actually realising that return. And you can see of late that we've been able to keep that volatility pretty consistent in the last couple of years, which have been a highly volatile market, been able to keep that around 6 to 8%, whilst the market's been trading around 14 to 18%. And we're quite confident with the underlying portfolio and how it's positioned that we can continue to generate those high single digit, low double digit returns with volatility of 6 to 8%. When we think about how we invest in life, and there's a couple of examples we wanted to share with you today, we take a very much a top-down approach where first of all, we look at the macro environment. And once we look at the macro environment, we then look at specific sectors within the macro environment that we believe will outperform, but also sectors to avoid that we believe pose significant headwinds. So if you think about that over the last few years, one sector we identified really early in 2020 when the COVID crash happened was resources. And we wanted the portfolio to have a bias to precious metals and resources. And at the time, Leif took the view that with the existing managers that were present in the market at the moment, we wanted to find a new strategy that could be very flexible and nimble and very active in what was quite a volatile market. So we partnered with a global resources manager and actually seeded the fund on day one. And that's one thing that our investors do get with Leif, is that we back managers early, and quite often through fund management research, you'll note that managers tend to outperform the most in their early years. And Leif has a mandate whereby I can support those managers early on. So we initially came into this fund on day one. We were one of only a few investors. It has a global resources mandate. It is incredibly flexible in how it can invest across markets within certain specific pockets of the resources sector, and can equally move out quickly without getting stuck. And you find with these larger managers out there that over time, they become liquidity constrained because they're too big, whereas our bias is towards supporting smaller managers that have more flexibility around their capital. And obviously the performance from this strategy since making that allocation has been very good, an annualized return of circa 64%. And we believe this manager actually has further room to grow. We recently increased our allocation to this strategy only about 6 to 9 months ago, because we believe there is further performance to be had in this resources super cycle. And another strategy is healthcare and consumerism. We spent some time with this manager in New York back in 2018, and at the time we knew this strategy was actually hard closing, i.e. not available for future capital. And so we took the view at the time that we felt that the tailwinds within healthcare were going to be quite strong. So we took a reasonable position in this manager back in late 2018, and it's took some time for that to unfold. So whilst this strategy has had exceptional performance for us in the past 2 years, it was a laggard on the portfolio initially. And that's one thing to be very mindful of with Leif. We promote returns of circa 8 to 12% per annum with lower volatility in the market, but over a 3 to 5 year period. We're looking for strategies that we think will emerge over a 3 to 5 year period as well. And we're happy to go into these strategies early with the view that theme will unfold in time. And we've seen that here, and that's obviously really helped us with COVID as well. It's been a terrible event, COVID, but it's allowed sort of healthcare and pharmaceutical companies to do well, and also consumer discretionary expenditure. And this manager has benefited from that. What's more pleasing is that the healthcare index in the US last year actually was down for the calendar year 2021, yet this manager was still able to generate a significant return. You can put that down to their active management, avoiding companies and sectors of the healthcare and pharmaceutical sector that weren't doing well, and taking a bias in the portfolio to those that were continuing to perform well. Other strategies that we're looking to support in Leif going forward at the moment include digital assets. We've been doing a lot of work on that, on the next wave in digital assets, particularly on the back of the success the fund has had over the past 2 years with a manager in Melbourne. We're very close to taking a small investment in I guess sort of the Web 3.0 phase within the digital asset space. We've also put on some hedging recently against the US dollar. A large portion of our portfolio does have USD exposure. And that is one thing to note with Leif. You're truly having exposure to a diversified global fund of funds with circa 30 to 40% of the portfolio at the moment offshore, and we expect that to grow over time. So that's just a really brief summary from Michael and I about Leif. The key points to take away is that LAIF is, a supporter of themes as they're emerging. It provides liquidity in the alternative space. It provides retail and wholesale investors access to investment funds that are often only allocated to institutional investors, and we often get access to these funds at a significant discount from a fee card perspective because we are an institutional investor ourselves. If you have any questions regarding LAIF in particular, please reach out to our office, and thank you for taking the time to listen to this presentation today.
Thank you.